The US dollar has ruled the world for decades. Almost every international trade depends on it. Oil, goods, loans, all counted in greenbacks. It has been more than a currency. It has been a symbol of power and stability. But the empire is showing cracks. Global reserves tell the story. The IMF reports that dollars now make up less than 58% of global reserves, the lowest in decades. Nations are diversifying. Euros, yuan, gold. The dollar is still dominant, but the cracks are real. Geopolitics is shaking confidence. Sanctions, trade wars, political tensions. Countries are planning for a future less dependent on the dollar. Middle Eastern nations, for example, are exploring deals in other currencies. Oil trades are no longer guaranteed to be in dollars. Inside the US, the pressure grows. Debt is at record highs. Inflation is eroding purchasing power. The Federal Reserve tries to stabilize the currency. But global markets watch every move. Every rate decision, every policy shift has a ripple effect worldwide. Confidence is fragile. The dollar supports major institutions, the IMF, the World Bank, NATO's financial systems, loans, agreements, policies, all tied to its stability. A weakening dollar threatens more than money. It threatens the system itself. Even gradual erosion matters. Imagine countries refusing dollar transactions, central banks diversifying aggressively, oil traded in euros, yuan, or digital currencies. Dollar-linked institutions face stress. The world could look very different. The signals are clear. Central banks in Asia and the Middle East increase yuan and euro holdings. The share of dollar reserves falls. China promotes the international use of the yuan through trade networks. Europe pushes the euro in energy deals. Slowly, the world is moving away from the dollar. Consequences could be severe. Rising US borrowing costs, market volatility, debt crises in vulnerable countries. Even small shifts could trigger cascading effects. But opportunity exists for those who adapt. Strategic planning could turn change into advantage. The broader question is not whether the dollar will collapse. It is how the world will adapt. The era of unilateral dominance is ending. A multipolar system is emerging. Multiple currencies, multiple centers of power. The shift is quiet, but it is happening. History gives clues. The British pound once ruled the world. Its decline was gradual, driven by economic change and global conflicts. The US dollar rose in its place. Today a similar shift may be underway, but this time technology complicates everything. Digital currencies change the game. China's digital yuan is being tested for international trade. Stablecoins and blockchain assets challenge the traditional banking system. Early stages, but the potential is massive. Technology could accelerate the decline of dollar dominance faster than anyone expects. The human side is crucial. Economies are not abstract. People's lives, businesses, and savings are at stake. Global markets magnify the impact. Decisions in Washington, Beijing, and Brussels affect billions of lives. The dollar's decline is also about power. Economic dominance drives geopolitical influence. As the dollar weakens, US unilateral power fades. Alliances may shift. New financial blocs could rise. Rules of trade may change. Those prepared will thrive. Those unprepared may struggle. What will replace the dollar? A new global currency? Regional blocs? Digital money? No one knows. The possibilities are thrilling and alarming. Each scenario carries consequences for governments, businesses, and individuals. Even now, the dollar remains influential. Its networks are deep, but its supremacy is fading. Countries prepare, institutions plan, markets adjust. The foundation is shifting. The greenback still wears the crown, but it is no longer unassailable. This is just the beginning. The decline will not happen overnight. It will be gradual, marked by shocks and innovations. Each step brings the world closer to a multipolar financial system. No single currency will dominate completely. The rules are being rewritten. For those paying attention, this is a moment to understand. The dollar's dominance is ending. Every empire faces challenges. The greenback has ruled for over a century, but the age of unquestioned supremacy is fading. A new world is forming, one of multiple currencies, multiple powers, and new rules. The question is simple: will the world adapt, or will it be caught by surprise when the dollar finally falters? The answer will shape global finance, geopolitics, and economies for generations. The greenback still reigns, but the crown is no longer safe. The world isn't just talking about change, it is acting on it. Countries aren't waiting for a crisis to hit, they are diversifying now. Central banks, the guardians of global wealth, are sending a clear message. They are reducing their dollar holdings. The dollar still dominates, but the share is shrinking. The International Monetary Fund's data shows the dollar's share of global reserves hovered near record lows. Some estimates put it around the mid-50s, the lowest point in decades. This trend is not random. It has been building for years. After the global financial crisis, and again after the pandemic, central banks began to rethink their reserve strategies. They held less in dollars. They added more euros, yuan, and even gold. And that is just the beginning. In Asia and the Pacific, the Chinese yuan, and even the Australian dollar, have gained share in official reserves. This might seem small compared to the dollar's dominance, but the direction is unmistakable. Central banks are seeking alternatives, not out of fear, but out of strategy. Because holding everything in one currency is risky. The dollar has been stable for decades, but political uncertainty and geopolitical tensions have made foreign reserve managers cautious. Sanctions can freeze assets. Trade wars can disrupt markets. These risks are real, and they affect how countries store their wealth. Even in the US itself, policy moves have sent signals. Tariffs, fiscal uncertainty, and debates over monetary policy have shaken confidence enough that some analysts believe the dollar's record decline wasn't just cyclical, it was structural. But it's not just about reserves. Trade patterns are shifting too. Long ago, crude oil almost always traded in dollars. The so-called petrodollar system underpinned global energy markets. Today, bilateral oil deals are sometimes struck in local currencies, yuan in Asia, rubles in parts of Europe, even rupees in South Asia. The percentage isn't massive yet, but it has symbolic weight. Countries don't shift trade currency on a whim. It takes strategy, time, and alternatives. But the shift is happening. Every new yuan-denominated trade agreement chips away at the dollar's network of obligation and influence. And then there's digital currency, a wild card few predicted would matter so fast. Stable coins, blockchain-based assets pegged to real currencies, have exploded in use. They operate outside traditional banking. They can move value across borders instantly, and many of them are dollar-denominated. The potential impact is huge. Meanwhile, China has been quietly advancing its own digital currency. Some versions pay interest, a feature most US digital assets don't offer. Suddenly, wallets in Asia, Africa, and even Europe can choose between dollar-linked stablecoins and yuan digital wallets. The competition is on. This matters because currency isn't just money, it is power. The more venues where one currency is used, the more influence its issuer holds. If global payments migrate to systems that bypass US banking rails, dollar influence erodes, even if the dollar itself still trades on markets. In simpler terms, you can weaken the dollar's authority without it collapsing overnight. Trade invoicing can shift, payments can bypass US systems, central banks can diversify reserves. Technology can create alternatives, and all of these trends reinforce one another. Some skeptics dismiss these changes as slow or insignificant. They point out that no currency yet matches the depth and liquidity of the dollar. That's true, the dollar still dominates global finance, but dominance is not static. It can erode gradually, through many small decisions, global partnerships and alternative infrastructures. In the BRICS bloc and beyond, there are deliberate discussions about reducing reliance on the dollar. These conversations once seemed fringe. Now they are mainstream among policymakers in Asia, Africa, and parts of Latin America. Nations with huge foreign reserves, large trade volumes, or strategic geographic positions are exploring these ideas seriously, and here is the twist. This global shift doesn't require anyone to declare the dollar is dead. No dramatic moment, no single collapse. It simply requires enough actors to reduce their dependence gradually, and that is already happening. Look at gold. For centuries, gold was the backbone of monetary value. It was pushed aside by paper currencies, but as central banks diversify, gold has regained importance as a hedge against currency risk. Demand for physical gold and other hard assets has grown. That is a strong signal. It tells the markets that big players are thinking long-term. They are preparing for a world where the dollar's role isn't absolute. They are planning for uncertainty. Now let's be clear, the dollar isn't disappearing tomorrow, No respected institution says that. Even amid these shifts, the greenback retains unmatched global liquidity, stable markets for debt, and deep financial networks that aren't easy to replace. But what is possible, and increasingly likely, is a more balanced global currency ecosystem. Imagine this. In 2030, the world has a multipolar financial structure. International trade uses a mix of dollars, euros, yuan, and even new digital currencies. Reserve portfolios are diversified widely. No single currency accounts for more than half. Payments can move through alternative networks that don't rely solely on US financial infrastructure. This isn't science fiction. Analysts and experts who study global finance see these scenarios not as extreme, but plausible, even probable if current trends continue. Some see this as a rebalance of global power. Others see it as adaptation to new technologies. For many smaller economies, it's about protecting sovereignty. They don't want their financial fate tied to the politics of one nation. They want flexibility. They want choices, and that is fundamentally reshaping global currency dynamics. The dollar may still be the largest piece of the puzzle, but the puzzle itself has grown, and its pieces are changing shape. As nations rethink the dollar, as digital currencies rise, and as new trade networks form, we move toward a future where dominance is no longer about one currency, but about who can adapt fastest, think strategically, and build resilient financial infrastructure. This turning point, this shift, is already underway. It may not feel dramatic day to day, but when history looks back on this era, it may mark the beginning of a new global financial order. And that leads us to the next chapter. Because if the world's trust in the dollar is shifting, the next question is urgent. What happens to the institutions built around it? The IMF, the World Bank, and global financial alliances. Their future depends on the answer. If the dollar loses ground, the ripple effect will reach every major financial institution. The International Monetary Fund, the World Bank, even NATO's financial systems, all of them are built on a dollar-centric world. Loans, aid, debt agreements, reserve requirements, they all assume the greenback is king. What happens if that assumption no longer holds? The IMF itself has warned that the dollar's dominance is in flux. Central banks are diversifying, trade networks are changing, and the world is exploring alternatives. This is not hypothetical. Countries that rely heavily on IMF loans are already asking for options beyond the dollar. Some are exploring euro-based lending. Others are eyeing yuan-denominated credits. The shift is gradual, but it is accelerating. The World Bank faces similar pressure. Its infrastructure and development programs have historically been dollar-backed. That provides stability, but also risk. If the dollar weakens further, the real value of its loans and bonds could fluctuate. Countries may start requesting loans in other currencies. Some may even prefer baskets of currencies or digital currency alternatives to protect against volatility. Digital currencies could accelerate this transition. Imagine a World Bank loan issued partly in a blockchain-based currency, accepted globally, without passing through traditional dollar rails. It's not science fiction. Pilots are already being tested. This opens doors to faster, cheaper, and more secure international financing. Geopolitics complicates the picture. Countries that once aligned closely with the US may now pursue autonomy in financial decisions. BRICS nations, for instance, have discussed creating a new financial framework independent of the dollar. This could include a shared reserve currency for trade among member states. Already, we are seeing partial implementation, with cross-border settlements increasingly avoiding the dollar. Europe is also making moves. The euro, long overshadowed by the greenback, is gaining ground. Energy contracts are now increasingly priced in euros. The European Central Bank is actively exploring international digital currency projects. The goal: reduce reliance on US financial systems and increase global leverage. As the dollar's dominance declines, the power of these institutions could shift. They may lose influence if they cannot adapt, but new institutions could rise in parallel. A multipolar system could see regional development banks, digital currency alliances, and new reserve frameworks taking prominence. Some experts predict a bifurcated system by 2030. Traditional institutions like the IMF and World Bank may still exist, but their influence could be shared with emerging regional and digital networks. Countries may choose partners based on stability, flexibility, and technological integration rather than historical dominance. For governments, this creates strategic urgency. If your nation's financial systems are tied too closely to the dollar, you risk exposure. If your institutions embrace multipolar finance, you gain resilience. This is why nations in Asia, the Middle East and Africa are exploring alternative frameworks now, even before any dramatic collapse occurs. Technology also plays a role. A blockchain, smart contracts, and digital payment rails can bypass old systems. They offer speed, transparency, and security. They also reduce reliance on US banks and the dollar. In some ways, technology allows a new financial order to emerge organically, without political declarations or treaties. The private sector is responding too. Corporations, especially multinationals, are hedging. Some price goods in multiple currencies. Others are exploring digital settlements to reduce exposure. The trend is clear. The dollar is no longer the only choice, and markets are reflecting that reality. Yet, the transformation is not guaranteed to be smooth. Transition periods are always turbulent. Existing institutions may resist change. Political pressures may slow innovation. Currency volatility could spike. But even in turbulence, opportunity arises for those who adapt. Countries, companies, and investors who anticipate the change will benefit. So who could replace the dollar's global role? Likely, it won't be a single currency. A basket system seems more probable. This could include the euro, yuan, and potentially a digital global currency. Some analysts suggest the IMF special drawing rights, SDR, could evolve into a more widely used settlement currency. Others predict blockchain-based reserve systems could complement or even replace traditional methods. The transition is already underway, quietly but steadily. Every yuan-denominated contract, every euro settlement in energy markets, every pilot digital currency project is a step toward a multipolar financial world. It may take years, even decades, but the direction is clear. For the United States, this is a wake-up call. Maintaining dollar dominance will require innovation, diplomacy, and strategic adaptation. Simply relying on historical power is no longer enough. Policies will have to address debt, inflation, and geopolitical tensions simultaneously to retain influence. From Africa to Asia to Latin America, nations are exploring ways to reduce dependence on the dollar. They are not abandoning it entirely. They are building resilience, diversifying options, ensuring they have choices in a rapidly changing global system. In short, the institutions we have relied on for decades may look very different in the coming years. Some will evolve successfully, others may see their influence decline, and new systems will emerge, faster and more adaptive, leveraging technology and global cooperation to meet the needs of a multipolar world. The story of the dollar is no longer just about money. It is about power, influence, and the rules of global economics. The decline of dominance doesn't mean immediate collapse. It means transformation, and that transformation is already reshaping our institutions, our trade, and our strategies. What remains uncertain is timing. How quickly will these changes unfold? Will there be crises that accelerate the shift, or will it be a slow, almost invisible transition over decades? Analysts differ, but all agree on one point. The world is preparing for a new financial reality, and as the financial architecture changes, the stage is set for new alliances, new leaders, and new strategies. The dollar's era as the uncontested king of finance is fading. What comes next is a story of adaptation, competition, and innovation. This is the turning point. The choices made now by governments, corporations, and financial institutions will shape the next 50 years. The next chapter of global finance is being written today, quietly but with profound implications. And the story does not end here. For while institutions are adapting, trade is shifting, and technology is rising, there remains one more critical factor: geopolitics. Because ultimately, no financial system can exist in isolation. Power, influence, and security always intersect with money. And that is what Part 4 will explore: how global alliances, conflicts, and emerging powers will determine the future of finance, and whether the dollar will retain any vestige of dominance in this new world. Money and power are inseparable. The dollar's influence has always been tied to the United States' geopolitical strength. Military might, alliances, trade networks, they reinforced the greenback. But now that connection is under stress. The world is shifting. Asia, Africa, the Middle East, and Latin America are asserting independence. Countries are building alternatives to dollar-dominated systems. Some are joining formal alliances, others are quietly forging trade networks outside the dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, are the most visible example. They are exploring a common financial framework. Some proposals involve a new reserve currency, partly backed by commodities, partly by digital assets. The goal is clear: reduce reliance on the US dollar. Russia has been active in promoting non-dollar trade for years. Energy deals with Europe and Asia increasingly avoid the greenback. Sanctions forced Moscow to innovate. What started as survival is now a model for other nations seeking financial independence. China is the silent architect of many shifts. The Belt and Road Initiative is not just about infrastructure, it is also about currency influence. Loans and contracts increasingly use the yuan. Digital yuan pilots are expanding internationally. China is preparing for a future where the dollar is no longer dominant. Europe is moving cautiously. The euro has strengthened in international settlements. Energy contracts are increasingly priced in euros rather than dollars. The European Union is exploring its own digital currency. Europe wants influence without confrontation, hedging against a declining dollar. Meanwhile, smaller nations see opportunity. Countries in Africa and Southeast Asia are experimenting with multiple currencies for trade. They diversify to protect themselves from currency volatility. This creates a network effect. More nations avoid dollar dependency, encouraging others to do the same. Conflict also drives change. Sanctions, trade wars, and regional disputes make countries wary of relying on the dollar. The US can freeze assets, restrict transactions, or enforce trade penalties. Nations want a buffer, a system that operates even when Washington applies pressure. Technology accelerates this transformation. Digital currencies, blockchain networks, and fintech solutions allow payments without traditional dollar channels. A transaction today can bypass banks entirely, using secure, decentralized networks. This reduces the US's ability to control global finance through the dollar. Military influence matters too. Nations with growing military power, China, India, and even regional coalitions, can negotiate trade and financial arrangements without fear of economic retaliation. Power is no longer solely measured in GDP or reserves. Strategic leverage counts. All of this points toward a multipolar financial world. Dollars, euros, yuan, gold, and digital currencies will coexist. No single currency will dominate entirely. Influence will depend on alliances, stability, and technology. Predictive analysis suggests that by the late 2020s, at least 30 to 40% of global trade could bypass traditional dollar channels. That means oil, gas, and raw materials may be priced in multiple currencies. Corporations will hedge accordingly. Central banks will continue diversifying. The world will no longer move in lockstep with the greenback. Emerging powers are not passive observers. They are proactive. China's yuan expansion, India's trade diversification, Brazil's commodity deals, Russia's energy contracts. These are deliberate moves. The strategy is simple: reduce exposure to the dollar and create alternatives. For the US, this presents a dilemma. Maintaining influence requires adaptation. Military strength alone cannot preserve dollar dominance. Innovation, diplomacy, and strategic alliances are critical. Domestic economic stability is equally vital. Smaller countries will continue to follow the path of flexibility. Africa and Latin America are prime examples. Their economies are intertwined with multiple trading partners. They cannot risk being overly dependent on any one currency. They are diversifying now, quietly but decisively. In the Middle East, energy markets are slowly shifting. Countries like Saudi Arabia and the UAE explore contracts in euros or yuan. This does not replace the dollar yet, but it weakens its exclusive grip. When a few major energy contracts bypass the dollar, global trade adjusts. The impact is systemic. Dollar-denominated debt, reserve management, financial contracts, all become more complex. Institutions must adapt, nations must hedge, corporations must strategize, and the geopolitical stakes are high. The winners in this new world will be those who combine economic foresight, technological infrastructure, and strategic partnerships. The losers may face marginalization in trade, higher costs for debt, and vulnerability to market volatility. The transformation is already visible. Asia leads, Europe hedges, Latin America and Africa diversify, and the Middle East experiments. Over time, these networks grow more robust. They reduce global dependence on the dollar incrementally, almost imperceptibly, but decisively. The final phase may involve digital currency integration. Central banks could adopt digital reserve currencies, blockchain-based clearing systems, and new international payment protocols. These systems could operate independently of the dollar, providing alternatives for trade and finance. By the early 2030s, predictive models suggest that a multipolar financial order will be solidified. Dollar influence will persist, but it will share power. Euros, yuan, and digital assets will all play significant roles. Nations will have more options and more autonomy in financial decisions. The question then becomes not whether the dollar will fall, but how quickly the world will adapt to a shared system of influence. This adaptation will shape global power, trade dynamics and international stability. And one final point, this shift is not just economic, it is strategic, political, and technological. Nations that fail to anticipate these changes risk being sidelined. Nations that act decisively will shape the rules of the new global financial order. The world is changing faster than most people realize, not through headlines, not through rumors, but through silent shifts in how money moves, where reserves sit, and how nations trade. We have arrived at the moment where the dominance of the US dollar is no longer guaranteed. It may never be the same again. To understand what's coming next, we must look at how ordinary people, markets and governments are being reshaped by these forces. Because when the dollar changes, everything changes. Every savings account, every mortgage, every international business deal, every retirement plan, everything connected to the global financial web feels the effect. But most people don't see it yet. Because currency shifts don't explode overnight. They creep up through trade patterns, reserve decisions, financial innovation, and by the time the world recognizes the shift, it feels like it came all at once. Let's begin with individuals and families. Most people think currency changes only touch bankers or governments, but that's not true. When a currency loses value as a global anchor, it influences prices at home. Imported goods become more expensive. Energy costs fluctuate. Travel becomes more costly. Even the price of your phone or laptop can be affected. If the dollar weakens relative to other currencies, Americans may face rising import prices. If the dollar strengthens against some currencies but not others, global markets become volatile. That volatility feeds into inflation, and inflation feeds into uncertainty. Savings lose value not only because of local inflation, but also because global investors adjust how they value assets. People with investments in stocks, bonds, or real estate will feel this. Pension funds, insurance companies, and individual retirement accounts hold assets based in many currencies. A shift in currency dominance means financial products must be re-evaluated. Long-term planners must consider a future where the dollar is only one of several major global currencies. That affects everything from children's college funds to retirement planning. Now, imagine what this means for businesses. Large multinational corporations already price goods in more than one currency. They hedge risk, they buy futures, they manage currency exposure. But small and medium-sized businesses, especially those that import or export, are usually far less prepared. A supplier in Asia may start insisting on payment in yuan or euros. A buyer in Europe may prefer to settle in euros or digital currency. That forces companies to adapt their pricing strategies, risk models, and treasury operations. Some will thrive, some will struggle, and some will not survive. The global marketplace becomes more complex, more competitive, more uncertain, and that's just business. Next comes governments. When a country's currency is no longer the unquestioned global reserve, its fiscal flexibility changes. Countries that borrow in dollars may find that debt service costs become more volatile. If the dollar depreciates sharply against other currencies, repaying dollar-denominated debt becomes easier, but exporting becomes tougher. If the dollar strengthens unexpectedly, countries that borrowed in dollars could face crippling debt costs. Developing nations are especially exposed. Many hold foreign debt in dollars because it was once the safest bet. That safety may no longer be certain. Some governments may find themselves negotiating new debt structures. Others may restructure old ones. And some may default. Not because they are irresponsible, but because the hidden assumptions of the last 50 years no longer apply. And make no mistake, a rising number of governments are aware of this risk. That is why you see so much emphasis on de-dollarization strategies around the world. It's not paranoia, it's prudent preparation. Now let's talk about global markets. The dollar has long been the benchmark for commodities, from oil to gold to grain. Oil traded in dollars created an entire financial ecosystem. Banks made loans in dollars. Energy contracts were priced in dollars. Even geopolitics revolved around this structure. But now major energy exporters are exploring pricing mechanisms in euros, yuan, or hybrid baskets of currencies. This doesn't have to replace the dollar entirely to weaken its global position. It only needs enough adoption to shift liquidity. Liquidity is the lifeblood of markets. If traders and investors start using euros or yuan more frequently in global trade, market depth shifts. That means interest rates adjust, borrowing costs change, risk premiums recalibrate. Asset prices across the world, stocks, bonds, real estate respond, and all of this happens quietly, piece by piece, without a sudden crash or headline event. Now, let's expand beyond money and markets to global influence. Currency is power. It determines who gets to set the rules, who gets to sanction, who gets to lend, who gets to help rebuild after crises. The US has wielded this power for decades. But as the world diversifies financially, influence becomes more distributed. Europe gains strength through the Eurozone, China expands influence with the yuan, and Belt and Road partnerships. Emerging economies, from Southeast Asia to Africa and Latin America, gain autonomy by building alternative trade systems. This is not a zero-sum fight, it is an evolution of influence. One where the traditional power centers must compete and collaborate, and where new power centers emerge. Now let's dive into the institutions. The International Monetary Fund, the World Bank, regional development banks. These institutions must adapt or risk irrelevance. They cannot rely on dollar dominance to govern economic stability anymore. The IMF's special drawing rights SDRs may gain new prominence. SDRs are already a basket of currencies. They could become a more neutral global reserve instrument. Some nations are advocating for expanded use of SDRs as a global settlement currency. If this happens, the world transitions toward a shared reserve system. This would dilute the dollar's weight, but could also stabilize global finance by spreading risk across multiple currencies. But transformation is rarely smooth. A shift toward SDR-based systems would require political alignment and trust among major powers. That's a tall order. Yet the pressure to adapt is growing. The World Bank and regional banks may offer loans in euro, yuan, or even digital currencies. Debt contracts could become multi-currency. This would protect borrowers and lenders from single currency risk. This also drives innovation in financial technology. Central banks are exploring central bank digital currencies, CBDCs. These digital currencies can be programmed for international settlement. They can clear instantly. They can bypass legacy banking rails. Imagine a world where countries trade directly through digital ledgers. No SWIFT dependencies. No correspondent banking bottlenecks. Instant settlement. Lower risk. Lower cost. This is not science fiction. Pilots are underway across Asia, Europe, the Middle East and Africa, and the competition is real. Countries that lead in digital infrastructure gain financial influence much faster. That is how technology accelerates this shift. But let's step back for a moment. All these changes, currency diversification, new financial tools, digital money, are responses to one fundamental truth. No system lasts forever. Empires rise, empires fall. The dollar emerged dominant after World War II. It filled a vacuum of stability and trust. But the world today is more complex, more interconnected, and more competitive. So what does this world look like in the near future? Let's imagine a typical global economy in the early 2030s. International trade involves multiple currencies. Oil contracts are priced in baskets of dollars, euros and yuan. China's digital currency is used in Asia-Europe rail trade settlements. European energy contracts settle in euros with digital clearing systems. African nations trade with blended currency systems tied to local institutions. Central banks hold diversified reserves. No currency above a simple majority. Global debt contracts include clauses that adjust for currency fluctuations. Corporations hedge in multiple currencies simultaneously. Retail investors invest in diversified currency funds, not just stocks and bonds. Parents saving for college consider currency risk as part of long-term planning. Retirees watch global currency indexes as closely as interest rates. This is not chaos, it is complexity. A new era, a multipolar financial world with shared influence and shared risk. And in this world the dollar still matters. It is not dead, but it is no longer alone. The greenback remains a major currency, but it shares the stage, with euros, with yuan, with digital currencies, with SDR-like reserve systems. The future is not a collapse. It is a transformation, one that rewards flexibility, foresight, and adaptation. So what should individuals do? Education, awareness, diversification. If you save, invest, or plan for the future, consider currency exposure, learn about global markets, understand that money today is not the same as money 10 years ago. What should businesses do? Strategize for currency risk. Embrace flexibility in pricing and settlement. Invest in technology that supports multi-currency operations. What should governments do? Strengthen financial stability. Invest in digital infrastructure. Build alliances that support shared economic growth. And prepare for a world where no single currency dictates global policy. This is the era of choice, of competition, of innovation, the era of a shared financial future. The dollar will remain powerful, but no longer absolute. This is the end of one chapter, and the beginning of another. The dollar empire has not collapsed, it has evolved. And in its evolution lies the next great story of global finance. A story not of one currency, but of many. A story of technology, of cooperation, of competition, of a world redefining the meaning of money itself. The greatest transformation in global finance in a century, and it is unfolding right now.